Happy New Year everyone, and welcome to the first investment series of 2015. My name's Anthony Kapitanovich and I'm once again joined by our Head of Investments, Chris Willaton. Chris, how did markets fare for 2014?
Look, it was a real mixed bag. The Australian share market was pretty flat, only up 1.1%. When you factor in dividends, it was up by 5.6%, so not such a bad year. Nowhere near as good as the US. The S&P 500 index was up 11.5%. China was even better, up by more than 50%. So a good year there compared to previous few years in China. There were a few shockers though. The Russian share market halved last year, and a few others such as Greece, Colombia, Brazil, Nigeria also put in bad years. The standout features of last year were things such as the oil price halving, iron ore price halving, but most of the major economic themes were a continuation of what we've seen in previous years. A US economy that was recovering, and talk of when US interest rates are going to be increased, a European economy that continued to flounder, and a Chinese economy that was slowing, but slowing at a manageable rate.
Chris, throughout 2014 in our investment updates, we spoke a lot about the US Central Bank and the stimulus it was providing and how that was impacting the markets. Now that's been withdrawn gradually. How does that impact the US market?
Well, the US Central Bank has actually stopped providing more stimulus. It hasn't actually withdrawn it yet, but it has ceased the additional stimulus. Up until October, it was buying billions of dollars of US government treasuries and mortgage-backed securities to keep interest rates low and essentially stimulate the US economy. Now, since October, there doesn't seem to have been a marked impact on share markets. It's been well flagged that they would be winding down that fresh stimulus, and the markets were well and truly prepared. What we have seen, though, over the last several months is more stimulus come through from the Japanese government, a similar quantitative easing program there. We've also seen increased chatter that we're going to see the Europeans embark on the same policy. Some might say too little too late. And that will possibly be in the next couple of months. And also the Chinese government, whilst not adopting the quantitative easing, has been stimulating their economy by spending a lot of money.
Whilst on Europe, looks like we're going to see another round of issues come up in the EU. What are your thoughts there?
Well, a lot of those issues never went away. And Greece, unemployment rate 26%, Spain unemployment rate 24%. You've got a lot of these economies that have never really picked themselves up off the mat, and people keep looking at Germany as a saviour of the European Union or the European economy. Germany's actually showing some signs of being a little bit more fragile now. So we've just seen in the last few days that deflation has reared its head again in Europe. That's no surprise, but for various reasons it's now making the front pages.
Three things I wanted you to comment on, which became quite prevalent towards the end of 2014. Iron ore prices continue to take a hammering. The Aussie dollar is down around levels that I suppose we did expect would come up, around that 80-cent mark, and also oil more of late. Significant drop in oil price. It's been quite interesting to watch. Yeah. What are your thoughts on those three key points?
Well, oil and iron ore both halved last year. And iron ore is Australia's biggest export. So that's hurt the share prices of some of Australia's leading companies such as BHP and Rio Tinto. The iron ore price was gradually falling away over the year. Oil, on the other hand, fell away in the second half of the year. So that halved in the second half. So needless to say, they had an impact on a number of Australia's larger energy companies. A significant impact on also a lot of energy exporters. I mean, I mentioned the Russian share market earlier. Russia's a significant oil producer, and their share market's been battered, and the Russian government's balance sheet has been smashed as well. So there could be some significant issues coming through from Russia over the next 12 months, economic and political. Where do those go? Where do those commodities go from here? Most forecasts are for iron ore and oil to be roughly in the $60 to $80 a barrel range and $60 a tonne to $80 a tonne over the next 12 months. Levels that are probably a little bit higher than where they are at the moment. So we're looking for stability in those two commodities. As far as the Australian dollar goes, it fell 9% last year against the US dollar, finished the year close to 81 cents against the US dollar. A lot of talk that we're obviously close to the fair value. We seemed a bit expensive up at parity against the US. I wouldn't be surprised if we see some moderate falls in the Australian dollar over the year, but I don't think we're going to see anything too significant there.
Chris, was there any positive standouts for the year?
Well, I think one theme that was quite notable was the strong performance of companies that the government has sold off. We saw CSL put in a great year, Telstra had a good year, and Commonwealth Bank was the best performing bank, up 10% for the year. The other very notable item was the float of Medibank Private, a $5.5 billion float, so pretty big one. The shares were issued to retail investors at $2, and the stock finished the year at $2.41. So over a couple of months, the stock's grown 20%. So not only was that a good news story for a lot of retail investors, I think it spoke a lot for the demand that the Australian public has, or Australian investors have, for good quality companies. Medibank Private is quite expensive, as is Telstra, as is Commonwealth Bank, as is CSL, but there's still a hunger for good stories with dependable earnings. So
obviously 2014 was an interesting year. There was a lot of different themes that drove the performance of the world markets and our portfolios. What's the next 12 months hold for us, do you think?
Well, I think in many ways it's going to be a continuation of what we've seen in the last couple of years. The most prominent themes, or some of the more prominent themes, have been a hunger for international companies, and that's become more thematic for Australian investors. They're pursuing growth opportunities offshore. So whether it's buying Apple, which is one of our biggest holdings, or Facebook or Google, or diversifying their investments internationally, or whether it's a focus on buying Australian companies that generate the bulk of their revenues from overseas economies or internationally. You know, companies such as CSL, Amcor, Ansell, Macquarie Bank, you know, they're all good performers for us this year, driven by the fact they generate significant revenues offshore. So I think that'll be one theme that's quite prominent. Another one has been a real a desire for yield, with interest rates down at 2.5% in Australia and expected to fall over the next 12 months. I think that cash returns aren't going to be high, and people will be looking for income from their investments. So Telstra had a great year last year because of the fact that people want high yielding companies. The banks weren't big performers last year, but their share prices were well supported by the fact they pay good dividends. I think that that hunger for yield is going to prop up those the share prices of those companies. And I think another theme that's going to be quite prominent too is we see some bottom fishing in a lot of these resources companies as people realise that, you know, oil price isn't going back to $20 a barrel and iron ore isn't going back to $25 a tonne. So I think people will start to see the likes of BHP, Rio, Santos, Woodside as good buying opportunities at some point over the course of this year.
Well, thanks again for your time, Chris. Look forward to another exciting year on the investment markets. I hope you've all enjoyed this most recent update of our investment series. Until next time, thanks for joining us.